Hello, everybody. Happy Friday. Today is September 17th. It's Friday, 2021. My name is Evan. Welcome back to our weekly stock market analysis video. If it's your first time tuning into one of these videos, thanks so much for joining us. Here's how they work. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets. Those are things like correlations and volatility, credit markets, sector performance, market internals, everything beyond price. We want to look at other markets, their relationships, and what they could be telling us about what could be happening with the stock market. And then in part two, we're going to jump into the charts. We look at those longer term trends, dissect price action a little bit closer, and try and position ourselves best looking ahead. So hopefully that sounds good. Hopefully you're in the right place. Let's jump into some of the headlines from this week. So we had another market sell-off into option expiration date. Surprise, surprise. This has become a very sort of predictable or certainly a watched trend throughout 2021. What this basically means is options expiration is on the third week of every month. And if you just look through your charts, take a look at some of these recent sell-offs each and every month over the past year, and you'll see that the market has been declining into these option expirations. Now, there's lots of reasons, and it goes beyond partly beyond my knowledge on really the market structure and intricacies of the structure of how dealers are hedging and all of that fun stuff. But we're going to kind of skip and gloss over that and just point out the fact that it happened again. And this week, we also had quadruple witching, which is a fancy term to basically say there were lots and lots and lots more option contracts expiring into this week's close. So the pattern we have seen as we have looked over the past year of trading is that the market tends to find some support, tends to find a floor right around this time, and then we see that rebound into the end of the year, into the end of the month or the turn of the month. We'll see if that happens, but we'll talk more about that a little bit later. We did see the Russell 2000 manage to hold green this week, which is a nice little surprise. It's been the week sort of underperformer here, so it's kind of nice to see that managed to actually stay green. And we also saw the US dollar, which strengthened this week and is actually threatening to break out. And the US dollar is a bit of a wrecking ball, so we need to be very careful here. If the dollar breaks out, that tends to wreak havoc on some other major markets. We'll talk about that a little bit later in this video as well. So if we tally up the performance here, right-hand column for this week, equity market performance, you can see Dow was in the red, SPY was in the red, Nasdaq in the red, Russell is holding green, good for the lone sort of duckling there. And then we have the world stocks, international stocks, were down the sharpest, 1.28%. So a red, mostly red board across the world there this week. Market internals. Things have gotten weaker here as well. So take a look at this first row. This is the NYSE 52-week highs minus lows. So every single digit here is representative of how many stocks, net stocks there were that made 52-week highs minus those that made 52-week lows. Basically, you want to see strong, high numbers in these columns. I prefer to see triple digits here each day, and we are down to the double digits and low double digits. So this has gotten me a little more concerned. I'm paying attention. It's still positive, but I'm going to be paying very close attention here if this continues to weaken. We can see the cumulative AD line here, also net negative on the week. That basically says, as in aggregate, as a whole, the average stock was lower this week than there was versus advancing. A little bit of a tongue twister there, but that is the analysis there. And then if we look at the S&P 500 stocks over 20 SMA, you can see we've got about 40%, just under 40% of stocks are over their 20 SMA in the S&P 500. So let's take a look at the 52-week highs minus lows over the past 30 days. So we look at this chart here, we say, give me all of the highs minus lows and sum it up every single day and tell me what we have. And you can see this trend has developed here. It is up and to the right, but notice it is starting to go a little more gradual here. So if we're looking at this with a fine-tooth comb, we can see the rate of change is sort of slowing a bit. And we're going to just, again, want to pay attention to this. It's still positive, so let's keep a glass maybe half full, a quarter full, third full, as we look at this for now. If we take a look at sector performance, you can see 2 out of the, what do we have, 11 sectors here, we're in the green. So the majority, again, speaking to breadth, was negative this week. We saw energy standing bright here, up 3%. We saw consumer discretionary up almost 1%. And then real estate was down, but down just slightly. If we look on the underperformers, we saw materials, utilities, industrials rounding out, the bottom 3 there. So they were your laggards this week. If we take a look at correlations, so I mean, the real standouts here, again, is just pointing back to the US dollar. Again, just as a reminder, these correlations are taken based on the past 10 days. So these are inherently short term and very noisy. But we can see, again, if we look at this row right here where my cursor is, UUP, take a look at the, again, strong negative inverse correlation to basically everything. And what that's essentially telling you is that as the dollar breaks out and moves higher, everything else is coming down. And so that's why we do want to pay attention to the dollar. That's why we look at it here and we take note of its influence on other markets. You can also take note, which is interesting right now too, gold and silver really trading highly correlated to what equity markets are doing. I haven't seen that in quite a while, but notice here, so gold is moving, 66 and to ACWX here, 80% correlated with equity markets. So again, could be that dollar influence, could be some other dynamics or flows going on, but those are some interesting observations there in terms of correlations. If we take a look at volatility, it's funny here. This looks like it might be a mistake, but it's not a mistake. This is really the week over week vol term structure. There was really no change. If you remember last Friday, we also closed over 20 here in the VIX. And then what we saw when we started this week was the VIX just dripped lower all week long until Friday, where we just pushed right back up to where we essentially came into the week with. So we effectively had no real change here in the vol term structure. We're back over 20 in the VIX. That's where things get a little dicey. So it'll be very, again, interesting to see how we resume trading now that OPEX is out of the way next week. Interest rates and credit. So we saw yields up across the board, more or less. We did see the long end of the curve here. So we saw 30-year yield actually come down. And what that means is the widely popular TLT rallied this week because it moves inverse to yields. So we saw TLT up, 30-year yield down. We saw credit markets still holding up and staying positive. That's good. So we're not really seeing any freak out or concern from the debt market, the credit market at all right now. And that is, again, a good sign. If we take a look at dollar and commodities, so here is that strength in the dollar, 0.6% to the upside. That's a big move for 1 week. You can see it is still negative over the past month, the dollar. So this is where, again, we're getting to sort of breakout levels, and the dollar is going to be interesting to see now if it's ready to make a move and continue to new sort of year-to-date highs. Saw gold down, silver down, Bitcoin up slightly, agriculture, crude oil, natural gas all up. So this is actually kind of impressive here that we still saw natural gas, crude oil, ag and Bitcoin actually staying green in the face of a rising dollar. You don't usually see those both happening at the same time. So put it all together and we take a look at our report card here. We get ourselves a solid B, a B for performance. We can see that we had equity market performance, which was a little bit lackluster. We got an X there, and volatility environment with that nice spike is giving us an X there, but market breadth's hanging in there. Risk sector still okay. Credit market is in fact probably the strongest of those three. So we got a solid B for our report card. Now if we take a look at our trading system, so these are the quantitative trading systems that we run here at the Trade Risk. This is how we invest our money. And we've got two trading systems here that are both predominantly long this market right now. They did take it on the chin a bit this week. So Merlin here has been notoriously fully invested for the most part all of this year. So it's been sort of rolling with the punches here, having a great year in terms of performance. But obviously when things are mostly down in this week, this is going to feel a little bit of pain. And so did our short-term system. Our short-term system has been accumulating on the long side this week. And again, kind of rolling with the punches a bit, rotating through positions, but still both had a net down week for this week. So that's how we're positioned. We'll be back here in just a moment with part two. One of the most common questions I get from traders after listening to one of our market analysis videos goes a little something like this. Evan, there's so much information. There's so much to consider. Should I be bullish or should I be bearish? And I respect the question because there is always a lot of information to think about and it's almost always conflicting. That's why these videos are designed to help you objectively frame out markets, but it is on you to execute and pull the trigger based on all the information that we talk about. Now, if you're interested in the stocks and ETFs that I am personally allocating to, then it is our Merlin and Lamerick trading systems. Merlin was built to invest aggressively during healthy market environments and then step aside and get defensive to avoid large corrections. It patiently holds trades for about a month at a time, and it primarily trades growth stocks. You can have a full-time job and easily execute on the signals after the market closes. Our Lamerick trading system is a much shorter term tactical strategy. It holds trades on average for just 4 days, and it trades long and short, which allows it to perform well in more difficult, choppy, and volatile markets, and still no intraday screen watching is required. If you want to learn more about these trading systems, head to thetraderisk.com/systems. There's also a link appearing in the top right hand of your screen. When you sign up for one of our trading systems, you'll be given a login to our website. You can access our nightly trade reports. You'll be put on an email list so you can easily learn more about the trading systems and follow along easily after the market closes. We also have 14-day free trials available. Head to thetraderisk.com/systems. And now let's get back to the show. All right, we are back here. We've got Warden TC2000 open. We're looking at our equity market grid. We got the S&P in the top left, Nasdaq top right, Russell bottom left, ACWX, which is international stocks, in the bottom right. We're looking at a weekly time frame. So each of these dots here represent 1 week, and the multicolored dots are a custom smart trend filter that we've developed. Just simply measures price, volume across time and helps us measure trend and trend strength. And the white dashed lines are price itself. Now, if we look here at our weekly picture of trend analysis, you can see that there has been no change to any of these markets from a long-term perspective. S&P still bullish, Nasdaq still bullish, IWM still hanging out in the eternal sideways chop, and then ACWX here, international stocks, back in the sideways chop as well. So that's the landscape. Not going to go into anything further here because even though we did close lower across most of these markets, none of these trends have changed or broken or just done anything different. Let's go down to a daily chart though. Let's look at the daily chart, and this is where we get a little more noise and we get a little more of a trend chop transition state. So if we look here at the S&P 500, for instance, you can essentially see that last Friday when we did our video, we transitioned lower to the yellow neutral state, and we spent most of the week below our smart trend filter, but notice not enough weakness or conviction to the downside to actually flip us to a sell signal yet. And surprisingly, I thought we would get it on Friday, but not quite. So we are down. You know, we closed down almost 1% on Friday, but notice we're still hanging yellow here. So there's still just enough strength. This noise filter that is inherent in this smart trend filter indicator that we've developed, which is why I like it, is to help smooth out noise and not get whipsawed so much, is still just hanging on. I would imagine if we have any type of down session Monday, this is going to turn and flip and produce a sell signal. So S&P 500 daily chart threatening to break down and roll over. Nasdaq certainly stronger here. So this sell-off on Friday did break us below the indicator, but notice it is still kind of hanging out close to it. So we're still a little bit stronger here in the Nasdaq. Russell 2000 surprisingly just hanging on to it as well. So again, it's back to this choppy state, and then same thing with the ACWX. So what we have here on a daily chart is just a mess. That's essentially what this is telling us. There's mixed signals, there's indecision, there's cross currents. That's what the daily trend is telling us. Let's take a look at price action. Let's see if we can get a little bit closer here in our analysis or understanding of what the heck is going on. So when we look here at price action, we can see that things do look messy. We have, excuse me, this pullback that we've been in since topping out around 45.40, let's call it. This was way back right at the start of September is essentially when this market topped out. And we've been in this sort of slide and choppy drift for the past 2.5 weeks or so. And we had this level on here, which you just saw me move, drawn from last week, and this was a level, this was an area of a short-term area of influence. It's where we wanted to see the market reclaim back over and get back above to the upside to start acting better, to regain some momentum, to demonstrate that buyers are coming in again. And you can see essentially it's been the battleground. This has been the resistance for this market all week long. And in fact, with Friday's session, it really sort of started to thrust away and close at new recent lows below this range. So if we wanted to really keep that close, tight magnifying glass here, you're starting to get the breakdown into Friday's session. That is not a good thing. Now, again, we're still in the little realm of noise here. So again, I just want to be a little bit mindful that when markets start to chop around in this very visible range, things get very dicey, and you can easily get these rug pulls at the bottom where suddenly we just shoot right back up. And then again, the tops get rejected quite often as well. And you really just need to, it almost pays to wait for that confirmation. So when we look at how we're set up into next week, if we see that weakness, I mean, if we are staying, in fact, below this 44.40, which is the low end of this chop, then it looks to me like the S&P is going to very quickly retest 43.80, which was the August lows here, and in fact, the bottom end of the July chop here as well. So it doesn't seem, far-fetched at all to even be down here Monday or Tuesday of next week if we're going to come in with some type of gap down or weak open on Monday. So let's keep an open mind about that. However, if we do see this gap up on future Sunday night, if we start holding up here, we start getting back into this range, then again, I just would be, of the mindset that we could easily just kind of push right back up here as well. So we're at a decision point, in other words, and we are looking for a thrust or confirmation or conviction one way or the other. Given the way this closed, it seems like the way we're going to come into next week will set the direction, set the tone for what we're going to be dealing with for the last week of September. So that's kind of the way I'm framing out this market. I think, you can keep things pretty tight. 44.85, that's what we need to really break above. And then we're right closing at this 44, call it 40 area. And that's what we want to see us again, closing above or below to give us that very short-term bias. Longer term, again, weekly chart, we looked at those trends. We know that we are teetering on coming into some longer term trend support. If I clean this up a little bit more, you can certainly start to see that we are at this interesting decision point as well. And I'm going to try not to be too biased the way I draw this, but let's just see. We're right here. And this is also quite an interesting spot right? So if you want to take this longer term view and say, okay, we've been trading in this little channel like this for the past 4 months, and now here we go at the bottom end of the range again, this is where, again, bulls, buyers need to step in and support this market. So that is the take there on the S&P 500. We've got the IWM, which is hanging in here, which is a good thing. I think the fact that this actually didn't totally roll over this week, especially in the face of that US dollar that was rising, is actually quite a good thing. It's a little optimistic here. The fact that we did see some bullish divergence out of the riskier sector of the market. So that was encouraging. We're still absolutely in no man's land here. So we're still just in this range that we've been hanging out in all year long, but we're trying to hang on to the middle of it. We showed some relative strength this week. That is slightly on the margins, a positive thing in my book. And then if we look at the Qs are, again, looking similar to the S&P 500, a little more constructive, a little more bullish because they are just holding up closer to the highs on a relative basis here. And again, they've pretty much went out on the week with just this 4 days worth of chop just still hanging out here. So very similar to the S&P 500. Let's see the tone of how we come into Monday. Do we gap down? Do we see a futures open higher? And then start to measure that commitment and stability into the week. So that's the way I'm reading the market. Hopefully that's helpful. Let's look at some other interesting markets here. So we got TLT. So TLT, the long bond, we talked about this actually closing green this week, which was good considering rates were generally speaking higher. But notice we tried to break out earlier in the week, looked pretty good right there, and then we kind of rolled back and we're sort of testing this little trend line again, and we're waiting to see if this is going to be some kind of false breakout that turns quite negative, or can the buyers regroup here and support this market. I still like the prospects of a TLT that breaks out here. It still looks to me like this wants higher, but so far, it just hasn't happened yet. So we're still waiting. I'm looking at this glass half full, but I don't have a position on in this, but it does, seem like to me, it wants to eventually break to the upside. If we take a look at oil, we can see this huge, messy range that this has been in, and it's back towards the highs. So, oil has been remarkably strong over the past 2021 for sure. And it is right back to highs. We would expect some resistance, some supply to come in around here. Seems like that's what it's doing. But, I think it's still, would be healthy to just chop around, move sideways a little bit after all the work it's done to the upside. If we take a look at natural gas, this has been obviously the late sort of second half story here for commodities. Natural gas has really been on fire to the upside. You can see it's cutting through all multi-month, multi-year resistance levels. Take a look at the weekly chart. It's one of the biggest consistent persistent uptrends that we've seen in natural gas in years. This has been a horrible trade on the long side for decades, frankly. And we're looking at an ETF here, so this isn't, this has some inherent drag in it, but still it has been on a remarkable run. This week certainly is pulling back and resetting a little bit. So for you dip buyers that are coming in here that want to play this momentum, that missed the move, natural gas 3 days down, keep an eye on it. Still heavy volume pouring into this. So looks, kind of interesting here if it can settle back down into the low 17s or so. So natural gas, keep an eye on that. And then finally, silver in terms of commodities has been looking pretty ugly here, down almost 6% this week. So this is, really in a rough spot. However, it is at multi-month support or prior support. This is where dip buyers kind of came in and silver found some bids, if you recall, way back here in 2020 in September and then in November, right at these areas. So it has been selling off pretty consistently. It's a bit stretched to the downside. So maybe you find a nice little bounce right here. And then how long that bounce can last is the $1 million question that we'll all need to pay attention to. So silver structurally looks pretty bad, but bad enough that it might be worth a bounce. So that's it. That's what I've got for major markets. Let's run quickly through the sectors and industries. So we got some simple scans here to just highlight some interesting sectors and industries that were moving this week. We've got one on the upside. What do we got? We got auto manufacturers. So this one here is standing out by itself. Good for the autos. Let's see what's even in this. So you can see 29 stocks here standing out to the upside. So you get some familiar ones like General Motors, like Ford, like Tesla, and some other names that I don't fully recognize. But there's your list if you want to see what was in a very strong industry and sector this week. If we take a look at the downside, things that weren't working well. So we had consumer electronics. I'm going to run through these real quick. Copper, so basic materials closing back towards lows. Credit services, it's not the worst, but still obviously not doing a whole lot. Diversified utilities, you can see 3 weeks down in a row, closing at the lows. Drug manufacturers closing at the lows, back to a multi-month range. We see education and training services, which, excuse the laughter there, but I mean, this has just been in this list endlessly this year, has just continued to get hammered to the downside. Farm and heavy construction back to the low end of its range. We got gold back down to the low end of its range. We got home furnishing and fixtures back to the low end of this multi-month range. We've got household consumer defensive back to a multi-week range. I mean, there is a theme here. I mean, we are seeing the sell-off, but we are coming into these longer-term support areas. So that is notable. We do have lots of sectors and industries that are, again, in this list, but we do have them lining up at lots of interesting levels. So again, keep an open mind when we're looking at these charts. Industrial distribution back down here. This one more convincingly kind of breaking down. This is metals and minerals. And then we have insurance brokers, which is just kind of reversing from the highs. We got shipping and logistics back to multi-month lows. We got paper and paper products back to this multi-month range lows. We've got personal services here, which has just been kind of basing for quite a while. We got railroads. We have real estate. And last but not least, the industrial ETF XLI selling off, closing at its lows and looking kind of weak here relative to some of these other sectors. So that's what I got. Lots to chew on, think about, look at. It's quad witching, it's opex, it's market weakness, it's seasonal weakness. Lots of interesting dynamics going on here. So hopefully everyone's managing it accordingly, appropriately. Hopefully these videos are helping. And as always, I want to thank you for tuning in and watching. Every Friday we do these videos. Actually, next Friday, I'm going to have a bit of a schedule conflict, so I won't be able to get this out at its usual time. Might have to be a Saturday that I publish this video, or maybe I'll get a real short one in earlier in the day next Friday. But I do have some scheduling conflicts, so we'll see what I can do next week. But anyway, thanks so much as always for tuning in. If you like these videos, do subscribe to our YouTube channel. Subscribe to the YouTube channel. Check it out on thetraderist.com. And if you like it, give it a thumbs up, share it around, all that good stuff. I'd really appreciate it. Have a good weekend. We'll see you back here next week.